Let me know once it's live. Okay.
It's live. It's going.
Good morning, everybody. Good morning, and thank you so much for joining us for our homebuyer seminar this month. So just a reminder while we're starting out that we are going to have our next seminar is going to be on April 10th at 10 a.m. So tune in for that. Any questions that you have, I would love you to put them in the chat. If you're on Facebook, just put them in the comments. I have someone watching that also, so we'll be able to answer you. So today I have our special guest. I'm going to ask her to introduce herself, but I'm also going to ask her something that you guys are going to get a kick out of because I loved it. She doesn't know that I noticed it yet. But our mortgage person for today that's going to help us out and answer all of our questions is Nicole Archibald. Welcome,
Good morning,
Nicole.
everybody.
She works with Wells Fargo. So we want to see your shirt, Nicole. What does that say?
Loan officers need closure.
Oh, look at that.
Yeah. I actually make real estate t-shirts. So I have some for realtors and lenders, and I actually just designed a few for some title people. So those should be coming out really soon.
Oh, excellent. Excellent. So I'm going to be reaching out to you for that.
Okay.
So what we want to talk about today, I wanted to definitely concentrate on mortgages because I wanted everyone as a new first-time home buyer, one of the most important things that you are going to need to do is you have to get qualified for a mortgage. So one of the things is, first question, is now a good time to buy? Absolutely.
Yes.
Now is the best time to buy. And let me tell you why. The interest rates, right, Nicole, are at an all-time low.
Absolutely.
Anything like this, and we're going to talk about later in the program how just interest rates alone could save you up to $25,000 over the year of your loan if you purchase now. So we just want to make sure that we talk about that. So you hear a lot of things about it being a buyer's market or a seller's market, and you're thinking, well, what does that mean? So I'm going to tell you right now, it's both. And it's your buyer's market because you have awesome interest rates that you can get that basically will put you in a good position to purchase a home that is right within your budget, and you can probably get more home than you normally would have been able to qualify for, or you're going to get it in that neighborhood. Now, I'm not going to lie to you. For buyers, the inventory is a little low. So you might have to work a little harder to get your house, but eventually we can get your house because the inventory is low. Now, that's why it's a seller's market, because the inventory is low. Sellers have, double the people looking at their property than they did, in the past, which is a good thing for the economy. It's a good thing for us. So I just don't want you as a home buyer, don't be nervous. Don't think, oh, you know what? I've been out there, I put offers on 5 properties and they didn't go through. It's not my time. Trust me, if you can save $25,000, is now your time? I say, yes, it is. Yes, it is. So I'm going to allow Nicole to introduce herself and to share anything that she wants to introduce, and then we'll jump into a little more. If you guys have any questions that you want to ask us, type them in the chat, and we'll, during the while we're talking, and I'll make sure that I ask Nicole, or if it's for me, I'll answer it. So Nicole, floor is yours.
Okay. Hello. Good morning, everybody. Happy Saturday. I am a loan officer with Wells Fargo, and I have been in the industry for about 4 years now. So it's been a lot of ups and downs when I came in. I do specialize with first-time home buyers and residential lending. So I would be the person that you would go to before speaking to a real estate agent, or be the person that a realtor may possibly refer you to as a buyer so that you can get qualified for a home. Because a lot of people first start by looking at houses, but they don't really know what budget they're in. And that's one of the challenges that a lot of people face. They're not really quite sure exactly what their budget is, and they're just in the wrong area of looking. So the first thing you want to do is obviously find your budget, see where you fit, see where you fall, and that way you can confidently go out there, look for houses that are in your budget, and know that you'll be approved for those loans, for those price points, and not have to second guess or feel uncomfortable about it. And then worry about your payment being too high. To what Marva said, it is a mixed market. It's very, very aggressive. It's new territory for everybody. So we're all kind of, you know, in it together, if you will, trying to, work our way through this pandemic season right now. It's been a whirlwind. It's been an emotional roller coaster for everybody, I'm sure. But we're just kind of working through it. And I feel like right now, a lot of first-time home buyers are getting the opportunity to take advantage of a lot of things. If you're fortunate enough to still have your job and still have your income, then I would say jump on it. I mean, there's nothing better than to own your own property and pay yourself your own equity and, not have to pay rent to somebody else. So if that's one of your goals, at least start with the information, get the knowledge that you need, and take the step and just ask the questions.
Very good. Thank you, Nicole. Thank you for that information. So what I want to add to that, I want to, whenever you're placing with what some people may not know as a first-time home buyer, whenever you are placing an offer, it has to come with a mortgage letter because the person that's going to consider your offer has to know that you've done your due diligence to make sure that you can afford this home. So to the point that Nicole made, you might go looking at $400,000, $500,000 homes because that's what you think you can qualify for. However, when you go and you sit down with Nicole, you qualify for a $300,000 to $400,000 home. And trust me, when you start looking at $400,000 or $500,000 homes, $300,000 homes are not going to fulfill your requirements. You'll be so disappointed. So we like you to go and start looking in your budget right away. So one thing I want to ask you, Nicole, people usually talk about getting pre-qualified. So I would like you to explain what is a pre-qualification versus a pre-approval. What's the difference?
Oh, that's a good question.
Yeah.
So a lot of people, when they go start their application process, you do what's called the pre-qualification. And that means basically you sat down with a lending person, a lender like myself, and kind of verbally go over everything that you're interested in. So we can say, okay, I make $50,000 a year and I pay about $700 or $800 a month in bills as a total. And I don't have any car notes and I don't have any student loans. And I think my credit score is about a 720. So that's basically what a pre-qualification will do. It'll pre-qualify you based off the information that you provide. Now, the pre-approval is one step further, meaning that we pulled a copy of your credit report. We verified and double checked everything, or fact checked rather, everything that you told us. And your credit report reflects that. And that lets whoever know, like a realtor or someone else that you're putting an offer in with, lets them know that, hey, this lending professional took a look at their income documents, their bank statements, and they, verified assets, they verified the credit score, and they verified that there are no bankruptcies or anything that would hinder you from getting a mortgage commitment. But basically it just means that you pulled a credit report at the end of the day, because some people, when they're house shopping, they just kind of want to know where they would fall based off the information they have, which sometimes can be twofold. It could be a double-edged sword. Some people really know it and some people are off by a little bit, and your financial picture has to match exactly what's on that application. So if you tell me your credit score is a 720 and then I pull it and it's a 640, that's going to make a huge difference in your payment every month. So, or if there's, a monthly payment that you forgot to include, that's something that will make a big difference. So it's not anything that you need to be necessarily nervous about. It's just more, I would say, just try to be as honest and open as possible when you're discussing your financial picture with your lending professional. The reason being is because, let's say something comes in down the line, there's not much we can do if we don't know about it. So if I can't save you if I don't know about the problem. So if there's anything that, we ask, it's just not because we're judging. It's not because we're being nosy. It's not because we're trying to be intrusive. It's because we really need to know to set you up with the best path possible for you to get approved.
Right. Thank you for that, Nicole. So sometimes we feel like we don't want to share personal information. This is going to be as personal as it gets for you. You have to tell your loan officer any and every situation so they can help you solve those situations and not wait until the closing table. I have had clients that we get to the closing table only once and they had a judgment. So we had to take care of it. And it ended up, they lost the house that they were looking for, but they could fix it in 10 days. And then we went looking for houses again. But just imagine, you spend 6 weeks looking for a house, you find the perfect house. And then, because you didn't share something with the mortgage person, so the title company not only pulls credit reports, they pull, court filings and all those things. So sometimes it's things that you may not even know about. So not saying that, you know, the person knew, but just make sure that you actually share whatever you need to share with your mortgage person so they can help you provide the best package for you, or they can let you know you can't buy now, but here's what you have to do in order to be able to buy 3 months, 6 months, a year from now. They'll work those things through with you. So we have a question here, Nicole. How long is the pre-qualification or pre-approval good for?
So that's a good question. It depends on the lender. Some lenders, their pre-qualifications are only good for 30 to 45 days. When you do the pre-approval, then I get them mixed up sometimes too. When you do the pre-approval and you pull your credit report, that credit report's good for 4 months, 120 days. So once you pass that stage and you say, okay, I have this pre-approval for, you know, $100,000, for example, and I want to start looking, and then 3 weeks later, you're like, you know what, I need a different pre-approval for a higher budget, and your income and stuff like that, your financial picture allows. All we have to do is just rerun those numbers and issue you a new one. As long as you're within that 4-month window, we can send you as many pre-approval letters that you need to submit as many offers as you like until you find that dream home and an offer is accepted. But after that 4 months, the only thing that happens is we just have to pull a new copy of your credit report. So the one major piece of advice that I tell people is when you are looking for a home and you do start that process, you do want to refrain from opening up new lines of credit. So don't do a loan application and then go buy a new car. You know what I mean? Because it's changing your financial picture, or open up new credit cards or run up those credit card debts. You want to keep it close to the same, because God forbid something happen and you extend past that 4-month period and we need to repull your credit report, your score may drop, your debts change, and that changes your qualification number. So just keep that in mind. If you know for sure you're going to get something in 30 days, do whatever you want. But I would suggest not doing anything until you get those keys in your hand, because to your point, Marva, anything can happen. You can get to the closing table and a disaster can happen last minute. So I just always advise, just wait. Don't do anything to your credit. And if you do, if you need to trade in for a lease or something like that with a vehicle, for example, I've had customers have that situation. Just talk to your lender and they'll tell you if it's safe or good or what to do.
Right. So that's a great point that you just made. If you are in the process of buying a home and you have, you're working with a mortgage person, what they would recommend is before you go purchase anything, or if you're thinking about it, talk to your realtor and or your mortgage person. Talk to the mortgage person first because they know your situation better. But me as a realtor, I would say to you, you need to talk to your mortgage person because, and I had that happen to me once. I was showing houses and my client pulls up with a brand new car. And I said,
oh my God, that stresses me out.
This car? And he's like, oh no, it's fine. And I said, yeah, you know what? You need to check with them and make sure that it's fine. So with that said, the reason I said that is I want to lean into what is a debt ratio and how does the mortgage company use that to help people buy homes?
Okay, so your debt to income ratio is it's exactly what it sounds like, the amount of debts you have versus the income that you bring into your home. And your debt to income is based off of your gross income, not your after-tax income. Income such as your W-2, let's say your 1099, if your qualifications allow, if you have a second job, child support income, alimony, Social Security, all of that is considered income. The only thing that we really can't use is unemployment. And unless, if it's temporary or seasonal, if you have let's say contractors, a lot of union workers, they go seasonal, and in the wintertime, they usually take unemployment for a couple months. But other than that, any regular income before taxes, even your Social Security, if you have pre-tax income, we use that pre-tax number. And then we take that versus what comes up on your credit report. So not what you pay every month, but what's on your credit report. So for example, I have a car payment and let's say it's $300 a month and I'm paying $400 a month on the car payment. It's not what I'm obligated to pay, it's what you actually pay. So we go by those base numbers that's on your credit report. And basically the lenders use the federal guidelines that Fannie and Freddie have set, or the FHA guidelines that are set, or the USDA that have set those guidelines. And sometimes these lenders have their own overlays or their own requirements on top of the federal regulation that we have to follow. So basically those numbers come from there. So for example, your FHA loans, we have maximum debt to income, back end ratio, meaning total debts versus income, including your mortgage payment, can go up to 56.99% of your income. So you can kind of do the math. So basically you want to be able to afford all of your bills and your mortgage with one paycheck if you get paid twice a month. So a lot of people don't really understand that concept because I know a lot of people live tight. I know I used to be that way myself until I got into this field. So it's like, wow, people really don't live check to check, or they only have, they have more than $200 between checks. Like it's hard to save. So I get that. But yes, in order for you to be in a successful position and be a successful homeowner, your lenders don't want to see you default on that loan or go into foreclosure. So we don't want you to have, too much debt for you to pay that becomes overwhelming, especially when it comes to risk assessment. So your debt to income, for most conventional loans at Wells Fargo, we normally write conventional loans. We try to keep them below 45%. We can get exceptions depending on your scenario. If it's a refinance or something like that, up to 50% debt to income ratio, but that's the max. FHA is a little bit more flexible. Like I said, they can go to 56.9, basically 57%. And again, with some, exceptions depending on the circumstance. And it depends on your credit profile as a whole. But the whole goal of that is to not put you in a position so that you'll not be able to afford your mortgage and have to eat ramen noodles. You know what I mean? Like we want you to be able to live and pay expenses and, be able to have, your air conditioner on in the summer. So we, don't want to set you up to the point where you can't afford your house.
Right. Okay, so Nicole just said a lot, and she had actually touched on some things that I was gonna, ask her questions on. So I have a quick tidbit for you. When you are looking for, so you're saying that you're ready to buy a house, and you say my budget is gonna be $1,700. That's how much of a payment that I think I'll be comfortable with. So now you're living at home with your parents. Here's my suggestion to you. Every month you take $1,700 and you put it in an account and don't touch it. Get yourself used to making that payment and see how comfortable it is for you. Plus, in 10 months, you're going to have a substantial amount of money saved that you can put down on your house. But it allows you to kind of just get used to making that payment. If you're paying $1,200 in rent, still do the same thing. $1,700, put the $500 in the bank. It just allows you to get comfortable because you don't want to start paying a mortgage, especially if you're, at home with your parents and or staying, you have roommates, whatever. If you're doing something by yourself, you want to make sure that you prepare for that. So this is just a little tidbit. That's kind of something that I did for myself when I decided I wanted to, purchase a home. I just started taking that money and I put somewhere where I couldn't touch it. If I saw something, a brand new outfit that I wanted to wear, go out with my girls. No, I didn't use mortgage money. So just remember that. So Nicole was talking about a couple of different things. She said FHA, she said USDA, and I know a couple of you are probably thinking, you're sitting there and you want to ask what you're thinking, well, maybe I should know this. You shouldn't, don't worry about it. So I wanted to ask Nicole, so there are different types of mortgages. So I want her to kind of get in depth with a couple of them for you. First one would be conventional. Then I figure FHA, and then maybe a veterans. And if anybody wants to hear about anything else, let us know.
Okay, so I mean, the conventional space is predominantly where I live for work, and I have worked with FHA programs as well. They're very similar, just different guidelines. Here's my only concern with FHA right now. The only issue I've been seeing is that with FHA, a lot of people in our community have only been told about FHA when that's not always necessarily the best option for them. So I don't encourage for someone to just go in and say, hey, give me an FHA loan. I'd rather someone say, hey, what are my options based off of my credit profile? Because just because, you're a first-time home buyer, that doesn't mean that you need to have an FHA loan. Personally, in my opinion, a conventional loan is not so bad. As long as you have a 620, then you qualify for a conventional loan. I don't see the purpose of you doing an FHA loan. At this point in this stage in the game, a lot of lenders are being very competitive. Conventional loans come with a 3% down program as opposed to 3.5% compared to FHA. So a lot of people don't know that, especially with Wells Fargo's program. It's not proprietary towards income. It doesn't matter. As long as your credit profile allows it, you don't have to have a certain amount of income to qualify for that. Now, when it comes to FHA, the FHA requires 3.5%. That program was developed some years ago in order to open up the doorway for some people who couldn't afford home ownership to be able to purchase a home. I mean, back in the day, conventional loans were 20% down and that's it. Who has that kind of money laying around now? A lot of people don't. So the FHA was definitely opening the door for a lot of, minorities to, purchase homes and have that dream of home ownership where they couldn't have done it before. Low to moderate income is definitely a space that needs attention, and FHA definitely fits that criteria. And the main thing is just starting out with the knowledge, and just knowing what the guidelines are. So for example, what I was saying before, 3.5% down payment versus 3% down payment. Now we also have something called mortgage insurance, which is usually standard on any loan that doesn't have 20% down or more on a loan. So if you're putting anything less than 20% down, you're going to have mortgage insurance. With the FHA, it stays on for the life of the loan. Those guidelines have changed several times throughout the years that I've been working. It's only been 4 years in this industry. So you just want to keep checking the FHA website directly and just keep yourself abreast of that if that's something you're considering. Now, the mortgage insurance is based off of a few things. It's based off of your credit. It's based off of how much you're putting down, and it's based off your loan amount. Most of the time, it's a percentage of that loan amount. I do know that with conventional loans, the mortgage insurance is a little bit competitive. So it tends to be a little less from what I've seen. What else? Now with the VA loans, they do offer 0% down loans or 100% financing. I'm sure some people have heard. In order to qualify for that, you just need to be a veteran, obviously. And then if you want to put no money down on the loan, that's your prerogative. However, the VA does offer something what's called the funding fee, which is similar to the FHA upfront mortgage insurance premium. They're very similar. And basically what those things are for, it's in place to protect the lender and it's in place to protect you as the buyer. It does help cover a percentage of the loan amount based, depending on if you go into a default. So God forbid you can't afford your loan anymore, you go into foreclosure, that mortgage insurance is there to kind of pick up the slack and cover some of that loan balance. Because what people don't know is sometimes if you go into default and you didn't have that mortgage insurance, your lender's still legally able to still sue you for the balance that you owe and kick you out of your house. So you want to be protected and have that knowledge of what exactly it is that you're paying for and where that money is going, because a lot of people sign up for these mortgages and they just don't know the different parts to it. And then one other thing I wanted to point out is that on a conventional loan, you don't necessarily have to be a first-time home buyer to qualify for the 3% down program, which is actually pretty cool. That's something that kind of rolled out a couple of years ago. I want to say about 2 or 3 years ago. With FHA, they're very strict. You can only have been a first-time home buyer. So that means you can't have been on title for a property within the last 3 to 5 years. And then FHA would only come into effect, let's say I do own my home and now I'm buying a new primary residence, but it's a multi-unit. It's up to 4 units. That would be the only other instance that you would apply for an FHA loan. Conventional, usually, I mean, we could put you in a conventional if you're purchasing a new home, but you just have to put more money down. And that usually causes a problem for some people because a lot of people, like I said, don't have that kind of funding available right away. But it just really depends on your scenario. So I know I'm giving you a lot of information. I'm so sorry. But yeah, I know. I'm just trying to give as much as I can without overwhelming everybody. But for sure, if you have questions, I'll be more than happy to provide my information. I give you more of a one-on-one and get way more into detail with it. But that's the gist of it. 3% down for conventional, 3.5% for FHA, and you can put nothing down for a VA loan. And then the other thing is your credit score requirements. I meant to cover that. So for a conventional loan, minimum is 620. It doesn't matter. You have to have a 620, and that's what most banks start their credit requirements at. For an FHA loan, most banks require 640, which I know sounds a little bit backwards. Again, That's because their conventional programs are a little bit more appealing to the buyers when you can put down 3%, right? And then, like I said, if you have a 620, I don't see why you need to be an FHA loan at that point. And I also don't discourage buyers. If you don't have a 620, it's okay. There are lenders that will go down all the way to a 550. So I do advise what happens at that instance. There are different brackets with your credit score. So you can do it, it'll cost you. Sometimes it'll just cost you more in like fees and points. And if you're strapped for time and you really need to get into a home, I would always recommend trying your options, get into your house, fix your credit while you're in that house, and then you can refinance down the line. It's okay. There's always options. You can always change things. So I don't want these buyers or people listening to be afraid or scared that once you get a loan, you're married to that for 30 years. It does sound like a long commitment. That is a long time. I mean, getting a car payment for 4 years is a long time. So I can imagine what it's like paying 30 years, this one payment. But you can always refinance. People do it all the time to take advantage of the market and whatever works best for them and their family at that time. So you can always change your scenario and refinance from an FHA to a conventional if that's something that's available to you.
Thank you, Nicole. How many of you feel like me? Like, wow. Like,
I'm sorry.
no, you know what? I actually just learned something because I used to think that, when I have clients with a 700 or higher score, I thought that the conventional loan was totally based on your credit score. That if you had the, good credit score and debt ratio, that you got you got a conventional loan. I thought if you were at a 620, that a conventional loan was not available to you. So I just learned something new that I can kind of share with my buyers. So thank you so much for that. This was a lot of information. So I know some of you have questions. I have one here. It says, does your debt ratio versus your debt to income ratio affect the interest rate you receive on a loan?
Oh, yes. Okay. So a lot of times I'll get customers that call and say, what's your interest rate for the day? Or you could just go to any website, PNC, Chase Bank, Wells Fargo, and say, what are the mortgage rates? And they'll tell you the little rate and it'll, it's like a teaser. They always give you like the lowest rate that's available or that we have issued currently, right? You also have to read that fine print because that is something that a lot of buyers don't know. There's about 6 factors that come into play when it comes to choosing your interest rate, and they're called loan level adjusters. These loan level adjusters are something that is a whole nother day and a whole nother class, but basically it's things like your debt to income, your credit score, how much money you're putting down, which means your loan to value, how much money you're putting down on the property and your purchase price, the loan type that you're in, that stuff matters. How much assets you'll have after you buy. So all those things play a factor into your interest rate, but I can safely say, normally it's brackets. So you want to go from like 620 to 640 will normally be in that same bracket. And then anywhere from 641 to like 660 is another bracket, and so on and so forth. Now I can say for sure, I have seen customers don't get all married to your credit score, because I have seen people with an 800 credit score get the same rate as someone with a 620, just because their debt to income is too high. That means they're living way too far out of their means. So if you keep your debts as low as possible, I've always find that that's one of the best factors, and that's very hard to do, having that discipline. And I know this because I'm saving for my own house myself. So I just want to go take vacations now because the flights are cheap, and I just want to ride all over the world and do whatever I want to do and buy all these things because everything's cheap and I'm home all day and I have nothing else to do. But you got to just stick with your budget and stick with your plan. It'll be there. You can always get it later. You know what I mean? But keeping your debt as low as possible on paper is the best thing that you can, I would say, do. And that's the first thing that's going to shoot your credit score up. Very good. Thank you. So that is
you're welcome. Great information. So, usually if you definitely want to be below 50% of whatever your credit is. So if you have a card that's you can spend $1,000, you should always make sure it's paid down to at least $400 at, the end for the next billing cycle. So this way that will keep your credit score down. And you definitely need to use your cards. Don't not use your cards, because that's also something that helps your credit score. If you're not using cards, and they can't judge your credit worthiness as far as they're concerned. So if you're using your cards and paying them every month, you're setting up some kind of cycle that shows people that you're responsible, and your credit score will, raise because of that. So thank you so much, Nicole. So I'm going to take a short little break here. For my first time home buyers, I have a little book here. It's all about buying a home. So I'm going to put the link in here where you can click on this link and it take you there so that you can actually, order the book. It is free to you. Just have to put your information and I'll get it out there. But if you I also do have it online. I'm trying to remember my phone number here. So if you want to text me at that number, I can send you the online link and you can look at it on your phone, or in your email today. So just wanted to make sure I shared that with you. So Nicole touched on a lot of things. I had private mortgage insurance is something I was going to ask you. So you kind of hit on that. Let's see, do we have any questions on Facebook by any chance? Because I know I can't see those. Just want to make sure I don't miss out on anything.
No, we do not.
Okay, perfect. So just remember, we are live. If you have any questions, I can answer them for you. Just put them in the comments field. We will get those answered. Once again, this is Nicole Archibald from Wells Fargo for anyone just joining us. And the question of the day is now a good time to buy a home? And we say, absolutely, now is a great time to buy a home. So make sure that you are going, and if you do nothing else, just sit down with your mortgage professional. And we have Nicole's information. We'll make sure that you get it, and we'll actually post it in the comments of our Facebook feed so you can reach out to her. You want to sit down with your mortgage rep, and I say, even if your credit right now is a 500, you want to sit down with Nicole, show her what you have, because maybe your credit score is not the only thing you need to work on. Maybe it is. Maybe she can look at it and say, you know what, if you just do this and this, 3 months, you can buy a house. So what you want to do is just do your temperature gauge. And it's not a commitment. You don't have to, if you sit down and talk to Nicole, she's not going to be upset, right, Nicole? If you say, well, I'm not going to buy a house until maybe next year. That's not what we're here to help you. Today, it's all about the education to let you know, home ownership is your way to wealth. That's something that you can build wealth for yourself. You can build wealth for your family. And, it's kind of, I guess they say it's the American dream, but just want to make sure that everybody can get a fair share and own a house. So another thing, Nicole did mention that we talked about the different types of loans. So I want to share something with you as a buyer. Here's something that is happening in today's market. So I know you all are, and you can raise your hands or, do a reaction of some sort. I can see them, even though I can't see some of your faces, to let us know if you've heard about this happening. You have a house that you go to see and the price is $175. And you go see the house, you love it, you put an offer in, and people are putting in offers for what? For 180, 190, 200, right? And you're thinking, oh, I'm never going to be able to get a house. And then some of us are actually thinking, well, if, the prices are like this, I don't want to overpay for a house per se. So we're, because you heard about what the markets did in the crash, and the crash happened because of a couple of different things. We're not going to get into that now, but some of it was people were getting no document loans and things like that. And it's just things that they couldn't afford. There are so many things in place now, right, Nicole, to make sure that even if you pay an extra $10,000, $15,000 for a property, it's still going to be affordable for you.
Yes.
So that's something that you need to remember. And that's the thing with the low interest rates now. So I have a little thing that I put together. Nicole had nothing to do with this. So I want you guys to know, I just wanted to have something to kind of show you what getting a loan can look like. And so this is just showing you here, the home price, say for instance, that I'm not going to say this is not the home price. So say the home price, can everybody see that? Do I have to make it bigger? Or is it good?
I can see it.
Okay, perfect. So say the home price for this home is, say it was $175. You end up paying the $200,000 because you want to make sure you get the house. So this is a mortgage at 3%. You're putting down, I put here, you're putting down 5%. So you're putting down $10,000. That's your down payment here. And this is the payment without taxes or insurance, because I can't get into that. I just wanted to keep it very simple for you.
It's just your principal and interest.
Yeah, principal and interest, thank you, Nicole, is $991 a month, right? So this is you, what today's market, you get a $175,000 house and you pay $200,000 for it. So if you wanted to wait for a year or two because you're like, oh, it's too much competition, I want to overpay for a house, housing prices will, if you know, they are going to be increasing and going up. So say, for instance, in 2 years or a year, the interest rate goes up to, I have it here, at 4%. So now you're paying $200,000 for a house at 4%. Same house, down payment's the same, but look at your payment, your principal and interest. You're paying $100 more. So within approximately 8 years, I call it breaking even, but you would have paid off the extra money that you paid for the house, and you're going to be saving $100 for the next 21 years, which is like $25,000 if you're saving because you bought a house 2 years ago. You bought a house in 2021 versus waiting to 2022, 2023. The interest rate is going to always be the driving factor. So remember that we're at an all-time low. So is now a good time to buy a house? Absolutely. Now, me as your realtor and Nicole as your mortgage broker, we are not going to allow you to overextend yourself. There are lots of things in place to make sure that you don't do that. But this is for someone that if you have, a little extra money saved and you want to be in a certain area, in a certain school system, you want 4 bedrooms versus 3, and this house fits everything that you need, you might want to pay a little more for it because you want to ensure that you get the house because it has all that you need. And that's, and that the final decision is going to be yours. But I just want to make you comfortable that sometimes, even though you're paying a little more, in the end, you're really not. You're saving. After 5 years, you're saving no matter what you do. But $50,000 more, we're not going to let you do in a $200,000 neighborhood.
Absolutely not. Oh my God, I would die. It gives me anxiety thinking about it.
I know, right? This is good. So hopefully this is good news. So we have a Facebook question. Are your real estate taxes always a part of your mortgage payment?
No, actually they're not. So usually with first-time home buyers, I always recommend you include your taxes and insurance called, set up your escrow account. I usually recommend you set up your escrow account when you're purchasing your first home, just so you can get used to it. And then you can always remove it down the line if you'd like to. And I'll give you the reason why. But in order to set it up, the reason I'm telling you to do that when you purchase your home is because some lenders, they will give you a what's called an increase in your interest rate. They'll give you a interest rate adjuster for not having an escrow account. So I always recommend setting up your escrow account. And then if you want to remove it after 6 months to a year, and you're comfortable to pay it on your own, then I would recommend doing it at that point, but not when you're purchasing your first home. Now, in the instance where your taxes and insurance do adjust, because some people aren't aware, at the end of every year, you get what's called the escrow account analysis. And by law, we have to have a certain amount of money in that escrow account to cover in case there's an increase. And we can't have over a certain amount of money in there. So at the end of the year, there's a review that's completed by your lender. And if there's anything like $50 or over that number, they send you a refund check. So you'll see that and that'll come back to you. And then you'll get a form at the end of the year showing in the report and all that stuff. Some people don't prefer to have that escrow account analysis done. And the reason is because sometimes the escrow account analysis is completed after an increase in your taxes. And then by that time, there's a shortage in your escrow. So your mortgage payment goes up. So, you'll either have to pay that at the end of the year, or when that escrow analysis is completed, you can pay it in full, or they normally divide it by 12 and then you're paying it in your following year's mortgage payment. So that's the only downside I would say to having an escrow. Now, to be proactive as a buyer, I always recommend, because you're a homeowner now, you need to be aware of what's going on in your community. Check your county website. All of this stuff is free knowledge to you. You can just go right to your records office and find out. Your tax assessor will tell you if there's an increase, number one. Number two, pay attention to your mail. They always send you something in the mail, letting you know within a certain amount of time that there's going to be an increase in your taxes. So a lot of people, a lot of buyers, I understand you're busy, life happens, things go down and you just can't, you missed it. You missed something and you just didn't see that tax assessment come in, but you have to do your due diligence. Set a reminder in your phone, get a family calendar, put it down on your refrigerator. Like every 3 months, you have to check your records office just to ensure, because that's going to affect your cash flow every month. So I've seen increases as much as $100, $150. That makes a huge difference to some people. So just do your due diligence as a buyer, as a homeowner, and make sure you know what's going on in your community and what's going on with your property, so that if there is an increase, you can always send additional payments once that increase takes effect and put that additional funding into your escrow. So when that increase does hit, you're already there. You're good to go. The money's already there. So you don't have to worry about getting this huge bill at the end of the year and worrying about your mortgage payment increasing for the following year. And let's say you had a decrease in income because of COVID, you know what I mean? Like, who knows? You never know what can happen. So just try to stay proactive and just be in the know when it comes to your house.
Thank you, Nicole. Nicole is just so much knowledge today. I'm learning, which is great. You know, when you're in the industry, after a while, you think, I can't learn anything, but we learn stuff every day. Oh, I do know something that I did want to say to you guys. So usually people, when it gets time to share their credit score, we all get a little like, oh, I don't even want to share my credit score because it's so low, and you feel embarrassed. And so here's the one thing you have to know about us, Nicole and myself as professionals. We have seen it all. We have seen totally low credit scores, and truth be told, we may have experienced it and been in your shoes at one time. I know I was in college opening credit cards left and right. Those people giving me all this free money. And then reality set in because they asked me for that money back. And I'm like, what? Ooh, how much left to pay? What? Wait, I only bought something for $500. I'm paying $800 at the end of the year. So that, made me wisen up. But we want you to know, be comfortable. There's nothing. This is a judgment-free zone. When you are buying a home with myself, I can only speak for myself, and Nicole already spoke for herself. We're not going to judge you. What we're here to do is to help you build your future and buy your home. And we're going to let you know how you can do that and how you can build wealth for you and your family. So just make sure, get comfortable with that. We're not going to judge you. We're going to help you move forward. And we can do that with whatever circumstance that you have going on. So somebody asked, what about confidentiality? So I'm going to tell you about confidentiality on my part, and then I'll let Nicole talk about that on her part. So when it comes to my clients, I'm very confidential. I have some clients that might be friends. I might see them in circumstances outside of the business relationship that we have. I don't share anything with anyone. I will tell people sometimes that, they say, oh, I didn't know so-and-so was buying a house with you. And you won't know from me. You'll only know if that person tells you that they're buying a home, because I respect my clients' right to be private and decide what they want to do and how they want to move forward. And there are things that, we're just not supposed to share. So we have, as a buyer, my fiduciary responsibility is to make sure that I get you the best deal, save you the best money. So we're going to make sure that we keep all of your information confidential. So Nicole, how do you feel about that?
It's not how I feel, it's what the law says. So, when it comes to banking, especially with Wells Fargo, everyone knows, it's no secret, Wells Fargo has had their fair share in the media, have doing some things and got their hands slapped. So Wells Fargo is very, very, tight knit when it comes to privacy. The privacy is a huge, huge deal. We cannot do certain things. Like if I send an email to someone and I don't put a date on it to the customer and it's not in their file, I'm on a report. So it's literally that serious for us. I personally do the same thing. Marva and I, we've been, met up for lunch a couple times, and we've, gotten to know each other professionally. I don't care what it is, and I respect your boundaries as well as your customers. I don't ever try to overstep and get any information than what the customer wants to share. I also let that be known with my customers. Whatever we discuss is our thing. I really could give any cares in the world about what you've been through, because that's everyone's walk of life to have. My job is to get you in a house and figure out what we could do to get you where you want to be. So whatever you did, whatever mistakes you made, like you said, we've all been there. I've been there. I've had to rebuild my own credit a few times. So I trust me, I know what that struggle is like. So I'm not here to judge you. And I like to share that part of my story so that my customers feel comfortable to share with me so they don't feel like I'm talking at them, or they don't feel like I don't understand where they're coming from, because I really honestly do. And I feel like the education piece just hasn't been there for financial literacy and financial health. So it's all new. It's something that we're all trying to promote as mortgage professionals and as lending professionals and as real estate professionals. But yes, if there's something that you're like my client has, like let's say I get a commitment letter, they come out of underwriting and their file is approved. I'm not allowed to send that letter to the real estate agent unless the customer asks me to, because there could be private information on there. It's just like the HIPAA laws with doctors. They can't just share information to people that aren't the patient, even if it's their family member or something. I wouldn't want somebody sharing any of my information with someone I didn't give them permission to know, because it's just not right. You know what I mean? Like, your credit score is your business to share. Your money is your business to share. So even though Marva and I may be very good friends outside of work, she's not going to know what Jane Smith's credit score is and where she works and how much she makes. That's none of anybody else's business but hers. And my business for the professional need to know in reference to getting her qualified for her loan. So no, I do not share people's personal information unless the customer's like, listen, keep me out of it. Share what you need to share. Call me if you need anything. But you will always be copied on every single email that goes out to someone that's not you in reference to your personal information. And the second point that I did want to bring up is that as a lender, there are certain things that we do have to have. We do get what's called the borrower consent form signed once you're in the loan process. We do need that because we do have to share certain personal information in order to get your loan moving. So I need to speak to your attorney and get information from your attorney if you have one. And I need to speak to the listing agent about certain things. And I need to speak to the title company and share, certain information with them. So they're going to get sensitive information with that might have your social or might have your financial information on it, but we are the people, running the transaction. So we have to see that. So that's the only time we would use it. Or if, let's say, you have homeowners insurance and you don't really know what to say, or we need something updated on that. I'll send an email, copy the customer, and add that borrower consent form saying, hey, we have permission to get this information from you guys on the customer's behalf. We just need you to update this loan number. It's incorrect. And that's it. That's the only time we would really use your personal information without your knowledge.
Right. And with that said, thank you so much, Nicole.
You're welcome.
Hope that's made everyone very comfortable with sharing your information. It's something that we make sure we keep confidential. And the one thing that I do for me with my clients is I partner with everyone that's helping you in that transaction. So I'm going to partner with the mortgage person. And, I tell my mortgage people, if they ask you for a paycheck stub and they don't have it, I'm calling you saying, hey, did you get the paycheck stub to the mortgage
Yep.
person that I'm going to be that gentle tap on your shoulder, reminding you that you have things. And if there's something that I can help you with, because sometimes the mortgage folks will send you, like I've had, I'm not sure what it's called, but people get like a little thing with credit run, something that popped up recently. And then you get this report and the mortgage company says, we need you to explain this. And you're looking at it like, well, like it's self-explanatory. This is this. I will sit down with my clients, and sometimes it's just as simple as, yeah, I have a credit card with this person, because just so you know, if you don't know, sometimes the people that you have credit with will arbitrarily run your credit report. So, when you see, you get a card and they increase your limit to like, it's 1,000, now it's 2,000. They probably have run your credit report. And I don't know if they can see, they probably can. They see that you're getting ready to buy a house. So they know, guess what? They're going to extend you more credit because you're buying a house. They're going to make more money. So that'll happen. So you'll see something that says, well, we'll use Sears. You did an inquiry and you'll say it was a soft inquiry. It wasn't your inquiry. It was Sears inquiry. So you just put, I have a credit card with Sears. I did not open any new credit. And I help my clients go through that list and fill that out and send it back to the mortgage company. So just little things like that. I'm going to also work with the attorney if there are things coming up that I can help you with or do for you or explain better to you. I do that also. It's all about having a partnership with the people that need to help you get into a home. And I make sure that I have that partnership. And I'm very uncomfortable when I'm working with people who don't want to have that partnership, because I don't want to not be able to help you. So I don't like having my hands tied. So I want to make sure I can share that with you. So Once again, I'm going to say this, is now a good time to buy a home? Absolutely, absolutely. So someone just said, I got two questions. Wow, I'm going to talk about one. So what is the best way to start repairing your credit? So I'm going to say to you, that is such an open question there that it really needs to be specific to your particular credit situation. So I say, you know what? Definitely give Nicole a call so we can, and she can set up an appointment so that you can look at what your credit situation is. Sometimes it's just as simple as paying down debt. You know, sometimes your credit score could be low because you don't use your credit cards, but without looking at it, we can't tell you what the best way is to repair your credit. But we did give you some tips. Pay your bills on time, lower your credit ratio. Make sure that if your credit card says you can use $1,000, that you don't have more than $400 carrying over as a balance. If you can. If you can't help it, you know, we understand, but if you can, you want to do that. So definitely you want to work towards, you know, call Nicole and she can do something more, you know, look at your credit score individually and talk specifically to your situation. So let's see. So someone question here, and I'm going to read it through. If you inherit a debt-free home and your name is on the deed or title, how does that affect anything when buying a home? So are you saying so you're gonna have to clarify that a little bit, unless do you understand it or you need me to clarify it too?
Oh, no, I understand the question. So
Okay, I'm gonna let you answer it.
because I have a couple customers in that scenario right now where they've inherited properties from their parents, or they become the estate, or they were on the title for a home that they didn't live in or they didn't buy. Technically, when you're on title or deed to another property, you're not a first-time home buyer. So even though you're not on the mortgage, if you have an ownership interest in a property, then you are no longer a first-time home buyer. That's how it's considered, unfortunately. So if you have to be careful if you're co-signing or if you agree to be on a property with somebody, because yes, it does give you legal rights to the home, but that does not make you a first-time home buyer anymore. Now, the first-time home buyer is not also it's not also the end all be all. I mean, there are some programs available for second time home buyers. You don't need, like I mentioned earlier, you don't need to be a first time home buyer to take advantage of a 3% down program. So it's not necessarily a bad thing.
Okay, that's good information. And you did say that if you're on a title, wasn't there a time frame where you can be considered a home buyer if it's
Yes, 3 years.
Okay, I remember you mentioning that. So all right.
And I believe if I'm not, I have to double check this, please forgive me. FHA might be 5 years, but the standard has always been 3. I'll have to double check for you though.
All right, sounds good. Thanks a lot. So I have another question. This is pretty much kind of sort of towards me. Nicole could get involved with something like this. So it's like, how does rent to own work? So you don't see a lot of that. Sometimes you do, but the thing that you have to remember is usually for rent to own, depending on who's selling the house, they do want you to have to get vetted by a mortgage person. Because the thing is, you need to know that if you rent for 2 years, at the end of 2 years, you're going to qualify to be able to purchase the home. Because let me tell you what's going to happen if you don't. There's a certain amount of money that you put aside to make payments that were supposed to be saved towards your down payment. If you can't buy the house when that contract is up, they get to keep all of that, if not a portion of it. So you have paid $5,000 to $10,000 extra dollars, and because you cannot qualify to buy this home, you're going to be out of that money. So that's something that you definitely need to think about, which is why when you're doing a rent to own, you have to make sure that it is a house that you absolutely love, because it does come with a little bit of risk. And so most people will let you go to a Nicole, and so you get your due diligence, and if your credit score is too low, whatever it is, and this way you can plan out what you need to do to buy this home, and you set a time frame for yourself to be able to complete that. So that's the best way to do the rent to own. Not a lot of people like doing that, because most people, when they're ready to sell a house, they're ready to sell a house. They don't want to be a landlord, but you have some people, some investors, or somebody who may be in a family home, and say if the market is a little tougher, you know, maybe we have the inventory is like out there, like there's like 100 houses for every buyer. then someone might look to say, you know what, let me do a rent to own. And that allows them to market to another kind of buyer who may not be ready now, but I can sell you the home or rent it to you, still make some money to pay the mortgage payments that I'm paying, and allow you some time to buy it. And that works for me because it gets it out of, you know, my hands, and I can at least get some income from the property. So that is kind of how the rent to own works. But I want to make sure that that's something that you guys, if you're going to do, you have to go into it with your eyes wide open and know that this is the home that you want. And I would also recommend that you get a lawyer to write out that contract. You should get someone, you know, a legal person, and it's, you know, it's not a whole lot of money. And even if it's $500, at the end of the day, think about it. In 2 years, if you save $5,000 to $10,000, you need a lawyer because you're going to want to get your money back. So that $500 would be well spent. And you're never going to get all of it back, but you would be able to get a portion of it back with an attorney and the right contract. So with that said, we have 3 minutes left. I like to respect everyone's time. I like to keep this an hour. Thank you, Nicole, so much for joining us today. So you guys know, I had someone else who's going to do it. Things didn't work out. So Nicole agreed to join us this morning.
Yes, I'm sorry. I would look way prettier if I had a little notice.
At like 9 o'clock. So I definitely want to get that out there so that you guys know that. And once again, I'm going to put the link in the chat for my book. If you wanted to get a copy of the book, I will send that to you. It's a complete guide to home buying. It has a lot of things that you wouldn't even think about. So I think we've covered just about everything. Do we have any questions on Facebook? I'm taking that as a no.
No questions.
Thank you. Anybody in the audience have any additional questions? All right.
I'm just sticking my email in the chat right now.
Oh, thank you, Nicole. So remember, now is an excellent time to buy. Interest rates are phenomenal. If you're paying rent $1,100 or more, you need to sit down with Nicole and you need to talk to her about where you are and what you could possibly be doing. You know, save the money, get the tax write-off for yourself. You might be able to purchase yourself a home. If not a home, maybe a nice condo. Maybe you don't want a house with a yard and all that other things. We'll help you get into anything that you need to. So there you go. So there's a hand up.
Yes.
So, that's my first time seeing that. That's why I'm like, oh, this is that.
It's a new Zoom feature.
Yeah, I wanted to make sure you didn't make a mistake and put that up. So go right ahead.
When is the best time to give a monetary gift for purchasing to someone who's purchasing a home?
Wow.
That is an
I'm going to let
excellent
Nicole
question.
answer that one. That's a good one. Yes.
That is an excellent question. I have had some deals almost fall apart because of the gift money. So you have to be very strategic in the way that you transfer the funds over. So if you're going to give money over to, let's say, a daughter, it has to be an immediate or direct family member. So the best way to do that is to write a personal check. And normally what I would do is I would recommend those funds be transferred before the application process starts. Because if you do that, once you go under contract, then that's when your bank statements are going to be requested. That's when your pay stubs are going to be requested, and so on and so forth. If they see a large deposit, an underwriter sees a large deposit into an account, they're going to ask where that came from. If that money cannot be verified or sourced is the word that's used. If that money can't be sourced, then they will not count that money towards any of your assets, and you have to make that money up somewhere else. So I've had a customer, unfortunately, she was given gift money from her husband, and I believe he was like a driver or something, and he had a cash business, like his income was cash only. And she provided a screenshot of his bank statement showing the balance of like $100 and then $10,000, and then a $10,000 check was written. So the underwriter was like, you can't use that. Like, where did that $10,000 come from? Even though it came from a donor and there was a personal check written, they provided the wrong documentation. So that therefore excluded the use of those funds, unfortunately. So whenever documents are requested, we're very, very specific. Only send what's asked. Do not send any more, and do not send any less. If you have to remember, talking to an underwriter is like talking to a detective, right? Like if you say something like, man, that killed me. Well, why would that kill you? Did you kill someone? Like they just get really suspicious about everything. They question everything. You know what I mean? So if they say, what was this address from? And, you had this whole long story. Did you live there? Did you rent? And did you own it? That's it. That's all you have to say. I used to live there. I never owned it. That's it. That's all you have to put. So same thing with the gift funds. If you have the opportunity to transfer it before the transaction even starts, I would recommend doing that so that you can have a bill cycle or two in your bank statement. The money's kind of sitting there maturing. And they won't question that because we can't ask for anything prior unless there's a reason to inquire about it. So if the money's already there, then your application's done, you're good to go. It doesn't always happen that way sometimes. If you do need to transfer the funds in between, make sure you just write a personal check. If you write a bank check or something else, money order will likely not be acceptable, but just something to have a paper trail. You're going to be able to prove where that money came from. So as a donor, we can't really request for a full bank statement from a donor unless we're given a reason to. For example, my last customer, we see no money and then $10,000 and then a $10,000 withdrawal. So now they're like, okay, we need to see your bank statement. And then that's going to raise some red flags. But if you have all the other proper documentation, the main thing that the underwriter is going to ask for when a personal check is written is just a screenshot of the cleared check from the donor account. Meaning, how you like log into your bank account and you'll click, it'll show you like the little check images that you've written from your account. That's all they need to see. And they need to see the little URL at the bottom to verify that it's from the donor bank account. And that's it. So as long as you can provide that information as a donor, it could be done anytime. But just for saving headache purposes and more paperwork, if that doesn't bother you, do it whenever. But if you want to kind of eliminate that part, then just do it before the application's even done.
So for parents out there, you want to give your kids some money, can't take it from your mattress and give it to them. Have it in an account. Because I know sometimes, they're looking for a house, but they might not find one for 3 or 4 months. And you don't want to just give them $10,000 because you want to make sure that they have that money for closing. So put that in your bank account so that because the bank will ask for your statement before you withdraw that money. And like Nicole said, and they want to see the check showing that money coming out. So if it's in your account, they'll do that. So just make sure that you have to have the money, and they are going to ask for your bank statement as the parent or the family member who is giving the money as a gift. And it has to be gift. You can't write at the bottom, it's a loan on the check. They will question that.
Yeah, because then it's going to change your debt to income because that's changing your financial picture. So if it's a gift, it needs to be a gift. Now, I will say, if you want to work something out on the back end, once that house is closed, that's none of our business. If you're giving a gift and you guys have a repayment plan some other time, we don't need to know about that. That's not our concern. Our concern is where's the gift coming from? And as long as it's not required as a repayment at the time it's been provided, that's all we need to know.
Don't tell Nicole about it. Okay?
Don't tell me about it. I don't need to know. No judgment, but that's okay.
Keep it to yourself. We have laws and rules that we have to follow. Once again, thank you all so much. I don't see any other questions. Remember the book, Buying a Home. Make sure that you get that. We're going to have this on Facebook. We are going to post the link for the book. We're going to post Nicole's information also. Thank you all for joining us. Thank you for all your questions. And hopefully you've learned a lot. And remember to join us next month, April 10th at 10 a.m. And I thought about it. We talked about it today. What I'm probably going to do is I'm going to have an attorney here. I am always going to try to have a mortgage person on with us because there's usually a mortgage questions that come up so that, they can answer. But, I'll let Nicole see what she wants to do for next month. But for you guys, thank you so much. April 10th, 10 a.m. is the next session. We thank you so much for coming out and have a great day.